Question 1. Annuity taxation. A client owns a non-qualified annuity and wants to take a partial withdrawal before reaching the age of 591. What tax consequences should the client expect? A. The withdrawal will be taxed as ordinary income and a 10% penalty may apply to the earnings portion. B. The withdrawal will be tax-free as it is a partial distribution. C. Only the principal amount withdrawn will be taxed as ordinary income with no penalty. D. The entire withdrawal will be tax-free if it's under the IRS threshold for early distribution exemptions. Answer. A. Explanation. In non-qualified annuities, any earnings growth are taxed as ordinary income when withdrawn. Additionally, the IRS generally imposes a 10% penalty on the earnings portion if the withdrawal is made before the client reaches 591, unless an exception applies. The 10% penalty applies only to the earnings, not to the original investment principal, since the principal in non-qualified annuities was already taxed. Therefore, the correct answer is they. Based on IRS guidelines and penalties for early withdrawals on non-qualified annuities. Question 2. Types of annuities in detail. Michael is considering investing in a fixed indexed annuity that calculates interest based on the performance of an external index with a participation rate of 70%, a cap of 8%, and no floor rate. If the index grows by 12% in a year, what will be the credited interest rate for Michael? A. 12%, B. 8%, C. 4.8%, D. 6.4%. Answer. B. Explanation. In a fixed indexed annuity, the credited interest is based on the index's performance, but only up to a capped amount and at a specified participation rate. The participation rate of 70% means Michael would receive 70% of the index gain. If the index grows by 12%, then 12% x 70% equals 8.4%. Since the cap is 8%, the credited rate cannot exceed this cap, meaning Michael will receive 8%. Thus, the correct answer is B. This reflects the mechanics of indexed annuities, where caps, floors, and participation rates determine credited interest. Question 3. Scenario-based. Annuity suitability and replacement. Mrs. Kim, a 7-year-old retiree, has a fixed annuity she purchased 15 years ago. Her financial advisor suggests replacing it with a new variable annuity due to recent market growth. Considering Mrs. Kim's advanced age, fixed income needs, and low risk tolerance, what would be the most suitable advice? A. Replace the fixed annuity with the variable annuity to capitalize on market gains. B. Keep the fixed annuity as it aligns with her low risk profile and provides a guaranteed income. C. Move the funds into an indexed annuity to balance potential market gains with some guaranteed returns. D. Cash out the annuity and invest directly in mutual funds to potentially increase returns. Answer. B. Explanation. Given Mrs. Kim's age, income needs, and risk tolerance, a fixed annuity is likely more suitable as it provides stable, guaranteed income without market exposure. Variable annuities, while offering potential growth, come with market risks that may not align with her risk tolerance or financial goals at her age. Replacing her fixed annuity with a variable one could subject her retirement income to unnecessary volatility, which is typically unsuitable for retirees with a lower tolerance for risk. NAIC suitability guidelines emphasize aligning product choices with the client's financial goals, age, and risk profile. Thus, the correct answer is B, as it best respects these suitability standards. Question 4. Risk assessment and management in annuities. A client interested in purchasing an annuity is worried about inflation risk eroding the purchasing power of future payments. Which type of annuity feature is specifically designed to address this concern? A. Fixed interest rate. B. Participation rate cap. C. Inflation protection rider. D. Market volatility shield. Answer. C. Explanation. An inflation protection rider helps protect against inflation risk by increasing the annuity's payments in line with inflation. Fixed interest rates, caps, and market volatility shields do not directly address the problem of rising prices. Inflation protection is especially important for retirees looking to maintain purchasing power in the long term. Therefore, C is the correct answer, aligning with best practices in managing inflation risk in annuities. Question 5. Sales practices and ethical considerations. An insurance agent is explaining the costs associated with a variable annuity to a potential client. Which of the following is an ethical and required practice under Hawaii's annuity sales regulations? A. Emphasizing the tax benefits and minimizing discussion of the fees. B. Providing a full breakdown of fees, charges, and surrender penalties to the client. C. Recommending the highest commission product as it typically offers more benefits. D. Describing only the minimum guaranteed benefits without discussing potential risks. Answer B. Explanation. Ethical and regulatory standards in Hawaii require insurance agents to provide clear, complete, and truthful information, including a full breakdown of fees, charges, and penalties associated with annuities. This transparency is essential for informed decision-making and protects consumers from misleading practices. Options A, C, and D would violate ethical and regulatory requirements as they do not provide balanced, accurate information. Thus, B is the correct answer according to Hawaii's annuity sales practices and ethical requirements. Question 6. Annuity suitability and appropriateness. A client, age 55, is deciding between a fixed annuity and a variable annuity to fund their retirement in 10 years. The client has a high tolerance for risk and is interested in potential growth. Which annuity is likely most suitable? A. Fixed annuity with a guaranteed rate of return. B. Variable annuity with diverse investment options. C. Deferred fixed indexed annuity with participation in market gains. D. Immediate annuity to start receiving income now. Answer B. Explanation. Given the client's high risk tolerance and interest in growth, a variable annuity may be most suitable as it allows investment in sub-accounts that can potentially yield higher returns, albeit with market risk. A fixed annuity or a fixed indexed annuity would limit potential growth, and an immediate annuity is not appropriate since the client does not need income until retirement. Suitability guidelines stress aligning the product choice with the client's financial objectives and risk tolerance, making B the correct answer. Question 7. Scenario-based. Annuity contracts and provisions. Mr. Sanchez, who is 60 years old, has a deferred annuity with a 10-year surrender period. He needs to withdraw funds for a medical emergency. What should he expect regarding any potential surrender charges? A. He will avoid surrender charges as he's over age 591. B. Surrender charges may still apply depending on the contract terms regardless of his age. C. No surrender charges will apply if the funds are used for a medical emergency. D. He will only incur surrender charges if he withdraws more than his premium amount. Answer B. Explanation. Surrender charges are based on the contract terms and are not automatically waived based on age. Even though Mr. Sanchez is over age 591, he may still face surrender charges if he withdraws during the surrender period unless the contract specifically includes waivers for certain situations, such as medical emergencies. Surrender charges are imposed by the insurer and do not directly depend on the age of the annuity owner unless specified by the contract, making B the correct answer. Question 8. Annuity taxation. Which of the following statements about tax-deferred growth in annuities is accurate? A. The growth in a non-qualified annuity is tax-free. B. Tax-deferred growth allows earnings to grow without immediate tax until withdrawal. C. Only qualified annuities provide tax-deferred growth. D. Tax-deferred growth applies only if the annuitant is over 65. Answer B. Explanation. Tax-deferred growth means that the earnings in an annuity grow without being taxed until the money is withdrawn, regardless of whether the annuity is qualified or non-qualified. In both types, earnings accumulate on a tax-deferred basis. Option A is incorrect as non-qualified annuities are not tax-free. Option C is incorrect as both qualified and non-qualified annuities offer tax-deferred growth. Option D is also incorrect as age does not affect the tax-deferred status of annuity growth. Hence, B is correct. Question 9. Regulations and compliance. An insurance agent licensed in Hawaii is discussing annuities with a client. Which of the following disclosures is required to comply with Hawaii's suitability standards? A. Explanation of all applicable surrender fees and penalties. B. Personal opinion on why annuities are better than other retirement products. C. Assurance of guaranteed high returns on a variable annuity. D. Only a basic overview of the annuity product features. Answer A. Explanation. Hawaii's suitability and compliance standards require agents to disclose all surrender fees, penalties, and other charges, enabling clients to make fully informed decisions. Providing personal opinions, guaranteeing high returns, which is misleading and likely untrue for variable annuities, or only offering basic information without full disclosure do not meet the ethical and regulatory requirements. Therefore, A is the correct answer as it reflects the requirements for transparency and client protection in Hawaii. Question 10. Advanced annuity topics. What is a primary benefit of adding a guaranteed lifetime withdrawal benefit ride to an annuity? A. It guarantees the principal will grow at a fixed rate annually. B. It allows for lifetime withdrawals even if the account balance is depleted. C. It waives all withdrawal fees for early distributions. D. It guarantees double interest credits in years with positive market performance. Answer B. Explanation. A GLWB rider allows the annuitant to receive a fixed income for life even if the annuity's account balance is depleted due to market fluctuations or withdrawals, providing financial security. This feature is designed to help manage longevity risk, which is critical for retirees who need assurance of lifetime income. Option A is incorrect as GLWB does not guarantee principal growth. Option C is incorrect as GLWB does not waive fees. Option D is incorrect as there is no doubling of interest. Therefore, B is the correct answer. Question 11. Annuity basics. Which of the following accurately describes the difference between a fixed and a variable annuity? A. A fixed annuity provides a guaranteed minimum interest rate, while a variable annuity's return depends on the performance of underlying investments. B. A fixed annuity's value fluctuates with the stock market, while a variable annuity has a guaranteed fixed return. C. Fixed annuities are subject to greater market risk than variable annuities. D. Variable annuities guarantee a fixed monthly payout regardless of market conditions. Answer A. Explanation. A fixed annuity provides a guaranteed minimum interest rate, which ensures that the annuity's value will grow at a set rate regardless of market conditions. A variable annuity, on the other hand, allows the annuity holder to invest in sub-accounts, typically in equities or bonds, and the return depends on the performance of these investments. Thus, A is correct. Options B, C, and D are incorrect as they misrepresent how fixed and variable annuities operate. Question 12. Annuity taxation. Which of the following scenarios would result in a taxable event for a non-qualified annuity? A. The annuity owner withdraws funds before the age of 591. B. The annuity is transferred to a beneficiary after the annuitant's death. C. The annuity accumulates interest at a fixed rate but is never withdrawn. D. The annuity owner exchanges the annuity under IRS Section 1035. Answer A. Explanation. In a non-qualified annuity, withdrawals of earnings are taxable as ordinary income when they are taken, and if they occur before the age of 591, they may also be subject to a 10% penalty in addition to the income tax. Option B refers to a death benefit, which is typically tax-free to the beneficiary under the applicable rules. C describes a tax-deferred situation where the interest is not taxed until withdrawal. D refers to a tax-free exchange under IRS Section 1035, which allows for the exchange of one annuity contract for another without triggering taxes. Therefore, A is correct. Question 13. Types of annuities in detail. Which of the following best describes a fixed indexed annuity? A. A fixed indexed annuity guarantees a fixed interest rate regardless of market conditions. B. The returns of a fixed indexed annuity are based on the performance of a specified market index with a cap on gains. C. A fixed indexed annuity provides investment options similar to those found in variable annuities. D. The fixed indexed annuity's value fluctuates directly with the stock market. Answer B. Explanation. A fixed indexed annuity is tied to the performance of a specified market index, e.g. SP 500, but the returns are subject to a cap or participation rate that limits the amount of interest credited to the account based on the index's performance. It offers some exposure to market growth but protects the principal from market downturns. Option A is incorrect because the annuity's return is tied to an index, not a fixed rate. Option C describes a variable annuity, not an indexed annuity. Option D is incorrect because the fixed indexed annuity's value is not directly correlated with stock market fluctuations. It is subject to a cap and floor. Question 14. Annuity contracts and provisions. Mr. Williams has purchased an annuity with a life with period certain option. What is the key feature of this type of annuity? A. Payments are guaranteed for the life of the annuitant with a minimum number of years. B. Payments are made only for a fixed period after which no further payments are made. C. The annuity pays a lump sum to the beneficiary upon the annuitant's death. D. The annuity provides guaranteed payments to the beneficiary after the annuitant's death. Answer A. Explanation. A life with period certain option provides payments to the annuitant for their lifetime, but guarantees that payments will be made for a minimum number of years. The period certain If the annuitant passes away before the end of the certain period, payments continue to a beneficiary until the full period is reached. B describes the term certain annuity. C refers to a death benefit, which is not guaranteed under a life with period certain annuity. D describes a joint tense of either option. Thus, A is correct. Question 15. Risk assessment and management in annuities. What is the primary risk associated with variable annuities? A. The annuity's principal is guaranteed and cannot decrease in value. B. The return on the annuity depends on market conditions and the performance of the selected investment subaccounts. C. The annuity's death benefit is subject to income tax. D. The annuity requires annual minimum withdrawals. Answer B. Explanation. The primary risk associated with variable annuities is market risk, meaning that the return depends on the performance of the underlying investments subaccounts, which are typically stocks, bonds, or other securities. Therefore, if the markets perform poorly, the value of the annuity can decrease. Option A is incorrect because the principal in a variable annuity is not guaranteed. Option C is incorrect as the death benefit is generally not taxed until withdrawn by the beneficiary. Option D is incorrect because variable annuities do not require annual minimum withdrawals, although there may be guidelines for distributions after a certain age. Question 16. Regulations and compliance under Hawaii law. When must an insurance agent provide a suitability disclosure form to a client purchasing an annuity? A. Only after the annuity contract is signed. B. Before the purchase of an annuity. C. During the free look period after the contract has been issued. D. The form is not required by Hawaii law. Answer B. Explanation. Under Hawaii's annuity suitability standards, insurance agents are required to provide a suitability disclosure form before the purchase of the annuity. This form helps ensure that the product is suitable for the client's needs and financial goals. A is incorrect because disclosure must happen before, not after, the sale. C is incorrect because the disclosure should occur before the contract is signed, not after. D is incorrect because Hawaii law mandates the disclosure. Therefore, B is correct. Question 17. Annuity suitability and appropriateness. Which of the following factors should an agent consider when determining the suitability of an annuity for a 72-year-old client? A. The client's risk tolerance, financial goals, and time horizon. B. The client's previous experience with investing in annuities. C. The client's age without considering other factors. D. The client's desire for high short-term returns. Answer A. Explanation. The suitability of an annuity for a client is based on factors such as risk tolerance, financial goals, and time horizon, not just age. A 72-year-old client may have different needs based on their retirement income requirements, risk preferences, and the time frame for which they need the annuity. Simply focusing on age, C, or desiring high short-term returns, D, may lead to an inappropriate recommendation. Therefore, A is correct. Question 18. Advanced annuity topics. What is the primary purpose of a guaranteed minimum income benefit (GMIB) rider in an annuity? A. To provide a guaranteed level of income regardless of market performance, but only after a certain waiting period. B. To provide an immediate lump sum to the annuity holder upon purchase. C. To allow for partial withdrawals without penalty. D. To guarantee a minimum interest rate for the life of the annuity. Answer A. Explanation. A guaranteed minimum income benefit (GMIB) rider ensures that the annuitant will receive a guaranteed level of income for life, even if the value of the underlying investments decreases. This income is guaranteed after a specified waiting period, often based on the contract's terms. Option B is incorrect because GMIB riders do not provide an immediate lump sum. C is incorrect because GMIBs do not focus on withdrawal penalties. D is incorrect because GMIB does not guarantee an interest rate but guarantees income. Thus, A is correct. Question 19. Sales practices and ethical considerations. An agent sells an annuity product to a senior client without fully disclosing the surrender charges. Which ethical principle has been violated? A. Duty of disclosure and transparency. B. Duty to maximize the client's return on investment. C. Duty to maintain the highest interest rate. D. Duty of suitability. Answer A. Explanation. The duty of disclosure and transparency requires agents to fully disclose all material information about a product, including surrender charges, so the client can make an informed decision. Not disclosing these charges violates this ethical obligation. Option B is incorrect because maximizing return is important but not the sole focus of ethical sales practice. The client's needs and situation must come first. C is incorrect because interest rate alone is not the key factor in ethical selling. It's about transparency of all terms. D refers to suitability, but the main violation here is not disclosing surrender charges, which falls under the broader duty of transparency. Question 20. Taxation of annuities in a qualified annuity. How are the earnings from the annuity taxed when withdrawn? A. The earnings are taxed at the annuitant's ordinary income tax rate. B. The earnings are tax-free when withdrawn, as long as the withdrawal is after age 591 wo. C. The earnings are taxed at capital gains rates. D. The earnings are not taxed unless the annuitant dies before the annuity matures. Answer. A. Explanation. In a qualified annuity, which is typically funded with pre-tax dollars, such as through an IRA or 401k, the earnings are taxed as ordinary income when withdrawn, regardless of the age at which the withdrawal is made. Option B is incorrect, because earnings from qualified annuities are never tax-free unless under specific circumstances. C is incorrect, as earnings from annuities are taxed as ordinary income, not capital gains. D is incorrect, because the earnings are taxed when withdrawn, not based on the annuitant's death. Question 21. Annuity death benefits. What happens to the death benefit of an annuity if the annuitant passes away during the accumulation phase? A. The death benefit is equal to the current value of the annuity, which could include the principal in any accumulated interest or investment gains. B. The death benefit is based only on the original amount the annuitant invested. C. The death benefit is equal to the sum of the total premiums paid, regardless of market performance. D. The death benefit is taxable to the beneficiary as ordinary income. Answer. A. Explanation. If the annuitant passes away during the accumulation phase, the death benefit is typically equal to the current value of the annuity, which includes any accumulated interest or investment gains. This ensures that the beneficiary receives the value that has accumulated up to that point. B and C are incorrect, because the death benefit can be more than the original investment due to market performance. D is incorrect, because the death benefit is not necessarily taxable unless the beneficiary withdraws funds. Question 22. Annuity payout options. Which of the following annuity payout options provides income for the life of the annuitant with no further payments after death? A. Life annuity. B. Life with period certain. C. Joint and survivor annuity. D. Refund life annuity. Answer. A. Explanation. A life annuity pays income for the annuitant's lifetime, and payments stop upon death, with no further benefits to beneficiaries. B. Involves a guarantee of payments for a certain number of years, even if the annuitant dies before that period is up. C is a payout option that continues for the survivor in the case of joint annuitants. D provides a refund of the premiums if the annuitant dies before receiving an amount equal to what was paid into the annuity. Therefore, A is correct. Question 23. Annuity riders. Which of the following is an example of a rider that can be added to an annuity to increase its benefits? A. Guaranteed minimum withdrawal benefit. B. Immediate payout option. C. Fixed interest rate guarantee. D. Beneficiary designation. Answer. A. Explanation. A guaranteed minimum withdrawal benefit, a common rider that guarantees the annuitant can withdraw a minimum amount from the annuity each year, regardless of the account's performance, even if the account value falls to zero. Option B refers to a basic feature of an annuity, not an additional rider. C describes a fixed rate annuity feature, not a rider. D is a standard contract feature, not a rider that enhances benefits. Question 24. Annuity suitability requirements. Which of the following is a key factor in determining whether an annuity is suitable for a client? A. The client's age alone. B. The client's retirement income goals, risk tolerance, and time horizon. C. The interest rate offered by the annuity. D. The annuity's current market performance. Answer. B. Explanation. When determining whether an annuity is suitable, an agent must consider the client's retirement income goals, risk tolerance, and time horizon. These factors ensure that the annuity aligns with the client's financial needs and goals. A is incorrect, because age is not the sole determining factor. C is incorrect, as the interest rate alone does not determine suitability. D is also incorrect, because market performance is not the sole consideration in determining suitability. Therefore, B is correct. Question 25. Annuity surrender charges. What is the primary reason for a surrender charge in an annuity contract? A. To ensure the insurance company recovers administrative costs. B. To discourage early withdrawals and maintain the contract's long-term stability. C. To penalize the annuitant for not holding the annuity for the full term. D. To limit the number of annuity transactions the company processes. Answer B. Explanation. Surrender charges are typically imposed to discourage early withdrawals and ensure that the annuity remains in force long enough for the insurance company to recover its costs and maintain the contract's stability. A is not a primary reason. While administrative costs are considered, the primary reason is to encourage longer holding periods. C is incorrect because the charge is not a punishment but a protective mechanism. D is not relevant to the purpose of surrender charges. Therefore, B is correct. Question 26. Taxation of non-qualified annuities. How are earnings from a non-qualified annuity taxed when they are withdrawn? A. Earnings are taxed as ordinary income on a pro rata basis. B. Earnings are taxed as capital gains. C. Earnings are tax-free when withdrawn. D. Earnings are taxed at a flat 15% rate. Answer A. Explanation. In a non-qualified annuity, the earnings are taxed as ordinary income. The tax is applied on a pro rata basis, meaning part of each withdrawal is considered a return of the initial investment, which is not taxed, and part is earnings, which is taxed. B is incorrect because earnings are taxed as ordinary income, not capital gains. C is incorrect because earnings are never tax-free in a non-qualified annuity. D is incorrect because there is no flat 15% tax rate for non-qualified annuity earnings. Question 27. Annuity settlement options. Which of the following annuity payout options guarantees a stream of income for the annuitant's lifetime with no further payments to beneficiaries upon the annuitant's death? A. Life annuity. B. Joint and survivor annuity. C. Life with period certain. D. Refund life annuity. Answer A. Explanation. A life annuity guarantees income for the lifetime of the annuitant, but payments stop when the annuitant dies, with no remaining benefits to beneficiaries. B. Provides income to both the annuitant and a survivor after death. C. Guarantees income for a specified period even if the annuitant dies. D. Guarantees that if the annuitant dies before receiving the amount invested, the difference will be paid to a beneficiary. Question 20. Annuity types. Which of the following annuities provides a fixed payout for a specified period and after which the payments stop? A. Fixed period annuity. B. Immediate annuity. C. Variable annuity. D. Deferred annuity. Answer A. Explanation. A fixed period annuity provides fixed payments for a specified period, such as 10 or 20 years, and payments stop once that period expires. B. Refers to an annuity where payments begin immediately, typically with no set end date. C. Involves variable payouts based on the performance of underlying investments. D. Is an annuity type that begins payouts at a future date. Question 29. Suitability of annuities. When determining if an annuity is suitable for a client, which of the following factors should an agent consider? A. The client's age and health. B. The client's risk tolerance, investment goals, and financial situation. C. The interest rates offered by the annuity. D. The reputation of the insurance company providing the annuity. Answer B. Explanation. The suitability of an annuity is determined by considering the client's risk tolerance, investment goals, and financial situation. These factors help ensure the annuity meets the client's needs. A is important but not comprehensive enough on its own. C and D are secondary considerations that do not directly determine suitability. Question 30. Annuity liquidity. What is a common feature of most annuities that provides limited access to funds in the early years of the contract? A. Surrender charges. B. Withdrawal privileges. C. Free withdrawal amount. D. Fixed interest rate. Answer A. Explanation. Surrender charges are commonly imposed by insurance companies to limit access to funds during the early years of the annuity contract. These charges ensure the insurer can recover costs associated with issuing the annuity. B and C refer to conditions that may exist alongside surrender charges, but surrender charges are the primary feature limiting access. D refers to the interest rate, not the accessibility of funds.